Welcome to TradingPennies.com Chart of the Week, where every week we will examine the trading strategy behind one of our explosive daily stocks picks. All of our strategies are covered in detail in our manual, Learn How Professionals Trade the Penny Stock Market, available on our site at trading-pennies.com. In our first video in this series, we demonstrated how to use information available on websites to develop your initial stocks watch list. In the second video, we showed you how to set up multiple time frame charts using moving averages most commonly used by professional traders. In this video, we're going to continue to look at the 6 most profitable chart patterns that you need to become familiar with to become successful trading the penny stock market. Today we are going to look at the very profitable pattern, gaps. When there is pent-up buying or selling pressure in a stock, it causes a sudden burst in price movement, forming a visual gap on a chart. There are a number of types of gaps that form, but the 2 most important are the breakaway and the exhaustion gaps. Depending on the type of gap, it is often a great predictor of future price movement, and as such a great way to generate profits in the market. Breakaway gaps tend to occur in the beginning or in the early stages of a newly formed trend. They will often occur at or shortly after base breakout plays and consistently signals a continuation of that trend. For a breakaway gap to have validity, the base from which it occurs has to be properly formed. Look for tightening in both price range and volume towards the right side of the base, with more volume on up days where the stock closes higher than on previous day than on down days. Look for the right side to have underlying support of a moving average used by the majority of traders. These were discussed in our second videos in this series. If a base breakout precedes the breakaway gap, as this example, look for a proper base breakout where the stock breaks above the base high with significant volume. For the exhaustion gap to be valid, look for it to occur at or near the base high and not from a price extended too far above the underlying support of a major moving average. The gap should occur on significant volume. Although not illustrated here, breakaway gaps are best traded using the intraday time period. As a general rule, when gaps occur, there are a number of things a trader must quickly do. The first is to check for news releases. Most gaps that occur on news releases are quickly lived, and to buy into these gaps prematurely is one of the quickest ways to lose your money. Most news events are known ahead of time, and insiders have already taken position and are looking to unload their shares into the volume expected at the news release. With no more buyers coming into the stock quickly falls. To add insult to injury, the experienced traders compound matters and begin to heavily short the stock, taking advantage of the novice traders both ways. If there is a news release before buying into the gap, look at the stock's price movement leading up to the news event. If its trend was moving higher going into the news release, you can be pretty much assured the stock's price move has already been built into the news release. In this case, it is better to wait. Even with no news release, it is better to wait until the froth of the early market trading winds down before entry. The classic entry is to buy if and when the stock trades above the high created within the first 20 minutes of trading, and only if this is accompanied with volume to the ask. Once a breakaway gap occurs, one can anticipate the price target of the advance. To do this, subtract the price of the low of the base from the lower price border of the gap. Add this to the price of the higher border of the gap to attain the projected price target. This represents a key pivot point and a place where you have to watch the price volume action very carefully. We will touch upon this here and cover this topic in greater depth in one of the upcoming videos. Exhaustion gaps tend to occur at the end or the late stage of an established trend, or when the stock's price is well extended above the support of a moving average. Exhaustion gaps usually signal an imminent change in the prevailing trend and should be played with caution. Exhaustion gaps are suspected when a gap forms far extended above moving average support, and the volume spikes 2 to 3 times the stock's average daily volume. Although not illustrated here, the angle of price movement virtually goes vertical on an intraday period. As the old saying goes, what goes up must come down, and stocks that demonstrate vertical price movement usually do so in the same manner. Don't get us wrong, a lot of money can be made playing exhaustion gaps, but those that do are nimble and are quick to take profits should some key signs appear. As with breakaway gaps, one can generally project price movement using the formula previously discussed. Subtract the price of the low of the base or consolidation from the price of the lower border of the gap, and add this to the price of the upper border of the gap to attain the projected price target for the move. When to enter and exit a trade will be covered in depth in future videos. Until next week, from TradingPennies.com, this is Thomas McClellan, where our goal is to help you learn to become successful trading the penny stock